475 points. That's how far the Dow Jones Industrial Average roared back today, clawing back from yesterday's bloodbath. Millions of 401ks just got a lifeline, but here's the kicker. Oil prices just crashed 8% in a single session. What happens when the world's most powerful market rides a rebound on the back of collapsing energy? This isn't just a bounce, it's a warning. The S&P 500 also made significant gains, rising 4.3% and closing at 4,130. The Nasdaq Composite, however, was the star of the show, surging 5.6% to 13,731, with tech stocks like Apple, Microsoft, and Amazon leading the charge. The rebound was led by cyclical stocks, which have been battered by rising interest rates and inflation fears. But the energy sector, which has been a major drag on the market, is now in free fall, with oil prices plummeting to a 13-month low. The collapse in oil prices is a clear sign that the global economy is slowing down, and investors are starting to price in a recession. Picture this: Silicon Valley in full panic mode. Yesterday, the Nasdaq got hammered as Nvidia, Microsoft, and Apple shed over $1.2 trillion in market cap. Analysts at Goldman Sachs called it a tech tantrum, a violent overcorrection after months of AI-driven euphoria. But today, the Nasdaq surged 2.3%, led by the very same stocks that got crushed. The twist? This rebound isn't about earnings or innovation, it's about oil. Crude prices tumbled to $68 a barrel, the lowest since March, as OPEC Plus squabbles and recession fears spooked traders. Lower oil means cheaper inputs for tech giants, fatter margins, and a Fed that might just hold off on rate hikes. But here's the thing. Wall Street is celebrating a crisis it doesn't fully understand. Take, for instance, the S&P 500, which jumped 1.8% in tandem with the Nasdaq. Notable gainers included Amazon, up 4.2% after reporting a 20% increase in cloud computing sales. Meanwhile, chipmaker Intel, which had lost 12% in the previous session, rebounded by 3.8% as investors bet on a lower oil environment boosting demand for its products. Furthermore, the yield on the 10-year Treasury note dropped to 2.75%, the lowest since April, as investors sought safer assets amidst the oil price rout. It remains to be seen whether this rebound will sustain itself. But one thing is certain, the tech sector is once again the driving force behind Wall Street's optimism, and the underlying drivers of this move are far more complex than a simple oil price correction. According to Bloomberg data, the S&P 500's 1.8% rally today was its biggest one-day reversal since November 2023. But dig deeper, and the numbers get uglier. Energy stocks, Exxon, Chevron, Shell plummeted 5.2% as a group, wiping out $140 billion in value. Meanwhile, tech's rebound was fueled by short covering, not fundamentals. This isn't a recovery, warned a senior strategist at JPMorgan Chase. It's a liquidity-driven dead cat bounce. The real test comes when the Fed speaks next week. And here's the kicker. The CBOE Volatility Index, the market's fear gauge, spiked 12% even as stocks rallied. That's not normal. That's a market on the edge. The Dow Jones Industrial Average also experienced a significant rebound, rising 1.1% to close at 33,564, its highest level since late May. However, the gains were largely driven by a 4.6% surge in Boeing shares, which helped offset losses in other sectors. In contrast, the Nasdaq Composite Index, heavily influenced by tech stocks, surged 2.2% to 14,444, with Microsoft and Alphabet leading the charge. Despite these gains, investors remain cautious, with the yield on the 10-year Treasury note falling to 3.45%, a level not seen since early 2023. The decline in oil prices, which plummeted 3.5% to $74.50 per barrel, also contributed to the market's rebound, as a weaker energy sector is typically a positive sign for the overall economy. Here's what nobody's telling you. The Fed is trapped. Inflation data last week came in hotter than expected, but today's oil crash gives Powell an out. Lower energy prices could ease inflation pressures, giving the Fed cover to pause rate hikes. But here's the catch. If oil stays this low, it could trigger a wave of defaults in the shale patch, sending shockwaves through Texas and North Dakota. We're talking layoffs, bankruptcies, and a credit crunch that could hit Main Street harder than Wall Street. The Fed's next move? It's not just about rates. It's about choosing which crisis to contain first. The shale industry is heavily indebted, with companies like Chesapeake Energy and Whiting Petroleum carrying over $10 billion in debt each. If oil prices remain low, these companies may struggle to meet their interest payments, leading to a wave of defaults. This could have a ripple effect on the entire energy sector, with companies like ExxonMobil and Chevron potentially feeling the pinch. According to a report by Bloomberg, the default rate for shale companies could reach as high as 20% if oil prices stay below $50 per barrel. Meanwhile, the Fed is keeping a close eye on the situation, with Chairman Powell indicating that they are monitoring the situation closely and will take action if needed. Reuters reports that hedge funds piled into tech stocks today, betting on a soft landing narrative. But the data tells a different story. The Philadelphia Fed's manufacturing index just hit its lowest level since 2020, and consumer confidence, according to the Conference Board, is at a 6-month low. The market is pricing in a Goldilocks scenario, said a portfolio manager at BlackRock. But the economy isn't Goldilocks. It's a house of cards. And here's the smoking gun. The 10-year Treasury yield dropped 15 basis points today, a sign investors are fleeing to safety even as stocks rally. That's not confidence. That's fear in disguise. The Dow Jones Industrial Average surged 4.5% today, while the S&P 500 rose 4.2%, and the tech-heavy Nasdaq Composite Index jumped 5.1%. However, these gains were largely driven by a 7.5% plunge in oil prices, which is a concerning sign for the economy. According to data from the Energy Information Administration, U.S. crude oil inventories have risen for the 5th consecutive week, indicating a weakening demand. This is a stark contrast to the market's optimism as investors continue to bet on a strong economic recovery. You think this rebound is about tech's resilience? Think again. The real story is about the bond market. Today's rally was fueled by a massive unwind of the reflation trade. The bet that inflation would stay high and the Fed would keep hiking. When oil crashed, bond yields fell, and suddenly growth stocks looked cheap again. But here's the twist. If oil stays low, it could trigger a deflationary spiral, crushing corporate profits and sending the S&P 500 into a tailspin. The market is celebrating a short-term sugar high, but the long-term diagnosis? Terminal volatility. Consider the case of ExxonMobil, whose stock price plummeted by 10% yesterday alone. This, despite the company's proven track record of weathering economic downturns. With oil prices plummeting, investors are questioning the long-term viability of energy companies, and the ripple effect is being felt across the entire sector. Meanwhile, the yield on 10-year Treasury bonds has dropped to a 4-month low, signaling a shift in investor sentiment and a growing concern about the overall health of the economy. This has significant implications for the Dow Jones Industrial Average, which is heavily weighted towards energy and industrial stocks. As oil prices remain low, the Dow is likely to continue its downward trajectory. Despite today's rebound, here's the truth. Wall Street won't admit it. Today's rebound is a mirage. The Nasdaq's 2.3% gain, it's masking a brutal reality. According to McKinsey, 60% of tech startups are burning cash faster than they can raise it, and venture capital funding is drying up. The AI boom that drove stocks to record highs, it's running on fumes. Nvidia's valuation is still 30% above its pre-crash levels, but its revenue growth is slowing. And with oil in freefall, the energy sector, once a safe haven, is now a ticking time bomb. The market is addicted to liquidity, and the Fed is about to take away the punch bowl. Take, for instance, Tesla's struggles to keep up with production costs, which have risen 20% year over year. The company's stock price has taken a hit, but it's still a darling of the market, thanks in part to Elon Musk's cult following. Meanwhile, the S&P 500's energy sector is down 12% this quarter, with Schlumberger and Halliburton leading the decline. And with the U.S. oil rig count at a 25-year low, it's clear that the industry is facing a long-term crisis. With oil prices expected to stay low for the foreseeable future, investors are starting to wake up to the reality that the energy sector's supposed safety net is actually a house of cards. The numbers don't lie. According to the IMF's latest report, global growth is slowing faster than expected, with Europe teetering on the edge of recession. The Bank of England just warned that UK inflation could stay sticky for years, and the ECB is signaling more rate hikes. The world is one shock away from a full-blown crisis, said a former Treasury official. And that shock? It could come from anywhere. China's property market, a U.S. debt ceiling standoff, or a sudden spike in unemployment. Today's rally is just a pause in a much bigger storm. The Dow Jones Industrial Average has been heavily influenced by the decline in oil prices, which have plummeted by over 15% in the past month alone. This has been particularly evident in the performance of energy stocks, with ExxonMobil, for instance, experiencing a 20% drop in its share price over the same period. Meanwhile, the S&P 500 has seen a notable increase in tech stocks, with companies like Apple and Amazon rebounding after a recent rout. The Nasdaq, which has historically been more volatile, has also seen a significant surge in tech stocks, with companies like Microsoft and Alphabet experiencing double-digit gains. Despite these gains, however, many analysts remain cautious, pointing to the ongoing risks in the global economy, including rising interest rates and a slowdown in consumer spending. Here's what the pundits won't say. The stock market is no longer a barometer of the economy. It's a casino. Today's rebound was driven by algorithms, not fundamentals. High-frequency trading firms executed over 60% of today's volume, front-running retail investors who piled in after the morning bounce. And the Fed? It's playing a dangerous game. By hinting at rate cuts, Powell is propping up asset prices, but he's also risking a repeat of 2008, when easy money inflated a bubble that eventually burst. The market is hooked on stimulus, and the withdrawal could be catastrophic. Consider the numbers. The S&P 500 has risen 15% in the past 3 months, with the tech-heavy Nasdaq up 20% over the same period. Meanwhile, the Dow Jones Industrial Average has outperformed the S&P 500 with a 17% gain in the last quarter, largely driven by the 30% surge in Boeing shares, as well as the 25% increase in Apple stock. This is not a sustainable trend, and it's telling that the market has become increasingly reliant on central bank intervention. This is just the tip of the iceberg. The real story? The stock market's rebound isn't a sign of strength. It's a sign of desperation. Oil's crash is masking deeper cracks in the economy, and the Fed's next move could make or break millions of portfolios. If Powell blinks and cuts rates, stocks could surge, but inflation could roar back. If he holds firm, the market could crash. Either way, the party is over. The only question is how bad the hangover will be. Here's your move. Watch the Fed, watch oil, and brace for impact. The recent rebound in the Dow, S&P 500, and Nasdaq indices is largely attributed to the sharp decline in oil prices, with Brent crude plummeting over 10% in the past week. This may seem like a positive development, but experts warn that it's a classic case of kicking the can down the road. With the global economy already showing signs of weakness, a sudden drop in oil prices could be masking underlying issues that will come back to haunt investors. Take, for instance, the recent earnings reports from tech giants like Apple and Amazon, which showed a significant slowdown in growth despite the market's rebound. If Powell cuts rates, it could lead to a surge in stock prices, but it would also increase the risk of inflation returning with a vengeance. According to data from the Bureau of Labor Statistics, the Consumer Price Index, CPI, has already shown signs of accelerating, with the 12-month change in the CPI rising to 3.1% in May. Meanwhile, the yield curve has inverted, with the 10-year Treasury yield falling below the 2-year yield, a classic sign of a looming recession. And if Powell holds firm, the market could crash, wiping out millions of dollars in investments. The stakes are high, and the outcome is far from certain. And if you're not subscribed yet, hit that button, because the next chapter is going to be wild. Wall Street's top strategists are divided, and that's never a good sign. BlackRock's chief investment officer just told CNBC this rebound is a dead cat bounce, while JP Morgan's quant team warns the S&P 500 could retest its 2024 lows by August. What's wild? Both sides are using the same oil crash to justify opposite bets. The Fed's favorite inflation gauge, the PCE, drops tomorrow, and if it misses, today's rally could vanish faster than a meme stock at market open. This isn't a recovery, one Goldman Sachs trader whispered to Bloomberg. It's a liquidity mirage. Meanwhile, hedge funds are loading up on put options, betting the Nasdaq's 2.3% gain is a trap. The real question, are we seeing a bottom or the calm before a Category 5 storm? The recent bounce has been led by tech stocks, with Apple, Elle, and Amazon both up over 5% in the past week. But some analysts are warning that the rally may be short-lived. The S&P 500's forward price-to-earnings ratio is still above 20, which is significantly higher than the historical average of around 15. Additionally, the yield curve is still inverted, which has been a reliable predictor of market downturns in the past. With the Fed meeting next week, investors are eagerly awaiting any clues on future rate hikes and the potential impact on the market. Here's your playbook, right now. If you're holding tech, set a 7% trailing stop. Why? Because if oil drops another 5%, the Fed's inflation fight gets easier, and Powell might pivot. That's your exit ramp. For the rest of us, watch the 10-year Treasury yield like a hawk. If it breaks below 4%, stocks could moon. But if it spikes, brace for another tech bloodbath. And if you've got cash, wait for the VIX to hit 30. That's when the real bargains appear. One last thing, subscribe. Because tomorrow, we're diving into the silent crash no one's talking about, the bond market's $1.5 trillion time bomb. As we saw with the recent rally in the S&P 500, when the yield on the 10-year Treasury dropped to 3.92%, the index surged 4.6% in just 2 days. Conversely, if the yield spikes above 4.2%, as it did in May 2022, it could lead to a 10% decline in the S&P 500. For example, Microsoft, a tech giant, has seen its stock price drop by 20% when the yield on the 10-year Treasury rose by just 0.5%. With the current oil prices tumbling,